Welcome back to the deep dive. We have a very specific mission today. We are looking at a stack of notes, regulatory texts, and study guides for the NISM Series-X-A certification. And specifically, we are tackling Chapter 12, Portfolio Managers.
The big one.
It feels like the big one, doesn't it? I mean, if you're a student or a professional trying to crack this exam, you know that Chapter 12 is where the rubber meets the road. We aren't talking about generic mutual funds anymore. We are talking about high net worth individuals, big ticket sizes, and a very different legal structure. It's a little intimidating, honestly.
It is, and it should be, to an extent. This is the VIP lounge of the Indian financial market.
Yeah.
And because the stakes are so much higher, the regulations are, well, they're a lot tighter.
Right. So here's the plan for everyone listening. We are going to treat this hour as a complete audio replacement for reading the text. We're going to strip away the jargon. We're going to explain the why behind all these laws.
Which is so important.
It is. And most importantly, we are going to hunt down every single number and metric that SEBI loves to hide in those multiple choice questions.
Sounds like a solid plan. By the end of this, you should feel like you've got a real handle on how a PMS, a portfolio management service, actually works in India.
Perfect. So let's start at the very top. Section 12.1. The text defines portfolio management. Now, I know what a portfolio is, and, I know what management is, but how does SEBI define it in a legal sense?
Well, they keep it broad, but also very distinct. At its core, portfolio management is exactly what you think.
Right.
Managing a basket of assets could be equity, debt, commodities, you name it, to minimize risk and maximize return for a client.
Okay, standard stuff.
But for the exam, and this is key, you need to focus on the entity doing the managing, the portfolio manager.
And the text gets very specific here. It says a portfolio manager must be a body corporate. That seems like a really deliberate choice of words. Why can't I, if I'm a wizard at picking stocks, just hang a shingle outside my door and call myself a portfolio manager?
Yeah, that's a great question. And the answer really gets to the heart of regulation. You can't do it because of liability and continuity. A body corporate is a legal entity, like a private limited company, that has a separate existence from its owners.
So it's not just a person.
It's not just a person. Think about it. If you as an individual run a proprietorship and something happens to you, you get sick, you pass away, God forbid, what happens to your client's money? The business effectively stops.
Chaos.
Utter chaos. Or let's say there's a massive lawsuit because of a bad investment decision.
Yeah.
If you're a proprietorship, your personal assets are on the line. Your house, your car, everything. SEBI wants a firewall.
So SEBI wants a layer of protection, a legal entity standing between the human being and the client's money.
Precisely. They want an institution, not just a talented guy in a garage. So for the exam, you have to remember this. Can a sole proprietorship be a PMS? At a partnership firm, it must be a body corporate. And they operate under a very specific and very important set of rules. You need to flag this for the exam. The SEBI Portfolio Managers Regulations 2020.
2020, got it. I'm noting that down. But surely PMS didn't just pop into existence a few years ago.
Oh, not at all. And this is a fascinating piece of market history that the text touches on. The original regulations actually date back to January 1993.
1993, wow. That's incredibly early for the Indian markets. The NSE was just getting started then.
It is. It's almost prehistoric in market terms. And in fact, if you look at the timeline, the PMS regulations came into effect before the comprehensive mutual fund regulations that we know today.
That is completely counterintuitive. I would have bet anything that the mass market product mutual funds would have been regulated first.
Anyone would think so. But it tells you a lot about who was moving the market back then. It wasn't the small retail investor. It was the wealthy, the family offices, the large ticket investors. SEBI realized very early on that they needed to bring structure and accountability to how high net worth capital was being managed.
So this has been a regulated part of the financial infrastructure for, what, over 30 years now?
That's right. It has deep roots.
Okay, so we have this body corporate, regulated since 93, with the rules updated in 2020. Who are these companies today? If I have my 50 lakhs ready and I want to open a PMS account, who are the providers?
Good question. The text breaks them down into three main buckets. It's a useful way to think about the industry. First, you have the big brokerage houses.
Like your ICICI Securities, your Motilal Oswal's?
Exactly. These are the big firms that already execute trades. For them, it's a very natural extension of their business. The pitch is simple. You're already trading with us. You trust our research. Why not let us manage the money for you too?
Makes total sense. They have the brand, the research, the infrastructure.
The second bucket is the asset management companies, or AMCs. These are the very same companies that are running your mutual funds, HDSC, AMC, UTI AMC, and so on. They usually open up a completely separate division just for PMS.
So they cater to both the retail crowd with mutual funds and the H&I crowd with PMS.
Correct. And the third category.
The text calls them boutique or independent PMS houses.
And these are often the most interesting ones. They aren't attached to a big bank or a massive brokerage firm. Usually they're founded by a star fund manager who left a big firm to start their own shop.
So you're not buying the brand, you're buying the brain.
You're buying the brain. You're buying their specific expertise, their unique investment philosophy. They sell themselves as specialists.
That gives us a really clear landscape of the players. Now let's get into the mechanics. Section 12.2 covers types of portfolio management services. We've just covered the by provider classification. The next one is by product class. This seems pretty self-explanatory: equity, fixed income, commodities. But I see mutual fund PMS on this list, and I have to ask.
I know where you're going with this.
It sounds totally redundant. I'm paying a PMS manager to buy mutual funds, where I'm already paying another manager. It feels like paying fees on top of fees.
It can feel that way, but think of it as a fund of funds approach, but for H&Is. There are, thousands of mutual fund schemes out there in India?
Yeah.
Picking the right ones, deciding when to switch, rebalancing, that's a full-time job in itself.
So the mutual fund PMS is for the client who says, look, I believe in the mutual fund structure, but I don't even want to choose the fund. You're the expert. You choose the fund for me.
Precisely. You're paying for the service of curation and active management at the fund level. And then, of course, there's multi-asset PMS.
Which is the true diversification play.
Yes. That's for the client who wants a single-point solution for their entire asset allocation. It'll be a mix of equity, debt, maybe some gold, maybe some REITs, or real estate investment trust. It's less about just picking the next great stock and more about managing the allocation between different asset classes.
Okay, now, I think we need to slow down a bit because we're hitting what looks like the most critical part of this section, the classification by services. The text distinguishes between discretionary, non-discretionary, and advisory. I feel like these terms get thrown around so loosely in conversation, but for the exam, the definitions must be absolutely rigid.
They are completely rigid, and the liability, the legal responsibility, shifts massively between them. So let's start with the most common one, discretionary services. It's in section 12.2.1 of the text. The key word is right there in the name, discretion.
Which implies choice. The manager has the power to choose.
That's it. In a discretionary PMS, the portfolio manager exercises their own choice, their own judgment, to buy or sell securities. The text says they manage the funds individually and independently as per the contract. They do not call you for permission before every single trade.
So if I sign up for a discretionary PMS, I am, for all intents and purposes, handing over the keys to the car.
That's the perfect analogy. Or, to use a different one, it's like going to a Michelin star restaurant and ordering the chef's tasting menu. You sit down. You trust the chef. You don't lean into the kitchen and tell him to put less salt in the soup or to swap the duck for chicken. You are paying for his discretion, his decision-making.
And the text also mentions this can be based on a standard strategy, or it can be customized. What does that mean?
Right. So a standard strategy might be something the PMS house offers to everyone, like a mid-cap Marvels strategy. You and 500 other clients might be in that strategy. But even then, the manager is still deciding when to buy or sell a specific mid-cap stock within that strategy for your account. You are passive, they are active. A customized strategy is for a much larger client who might say, I want a dividend yield focus, but with no exposure to tobacco companies.
Okay, that's clear. Now let's contrast that sharply with non-discretionary services, section 12.2.2.
This is the complete opposite. And the wording in the text is critical here. It says, the manager manages the funds in accordance with the directions of the client.
Directions of the client. So the manager can't pull the trigger on their own.
Never. They can do all the research, they can aim the gun, but you have to pull the trigger. They act as a high-level consultant or an executor. They might call you up and say, we've analyzed Tata Motors, we think it's a great buy at this price, and it fits your risk profile. Do we have your permission to buy 500 shares for your account?
And if I say no, or I want to think about it, they can't do anything.
Absolutely nothing. They have to wait for your explicit approval.
So going back to your chef analogy, What would this be?
This is like having a personal chef who lives in your kitchen. He does the shopping, he knows all the techniques. He comes to you in the morning and suggests, "Sir, the fish at the market looks incredibly fresh today. I think we should do a pan-seared sea base." But if you say, "No, I'm in the mood for a burger," he has to go and make you the best burger he can. He does the execution, the chopping, the cooking, the plating, but you decide the menu.
That's a fantastic distinction. So in non-discretionary, client decides, manager executes.
Flag that for the exam. That's the core concept.
Then what on earth is advisory services? Section 12.2.3. How is that different from non-discretionary? It sounds very similar.
It does. But there's one crucial final step that's different. In advisory, the manager only suggests ideas. They provide non-binding advice. But here is the kicker. The investor executes the transaction themselves.
Ah, so the manager doesn't even touch the money or the trading terminal?
Not at all. They just hand over the blueprint. They might send you a detailed research report saying, "We recommend buying Reliance Industries with a target price of X." And that's it. Their job is done. You then have to log into your own brokerage account and place the buy order.
So who uses this? It seems like a lot of work for the client.
It's typically for very large, sophisticated institutional clients. Suppose you are a massive U.S. pension fund looking to invest in India. You have your own team of traders in New York. You don't need someone in Mumbai to click the buy button for you. You just need someone on the ground in India to tell you what to buy. You just need the local expertise. That's advisory.
Okay, let's lock that in for everyone listening, because this is a guaranteed exam question.
Manager decides, manager executes.
Correct.
Non-discretionary. Client decides, manager executes.
Perfect.
Advisory. Manager advises, but the client decides, A&D, the client, executes.
You've got it. If you can just remember that hierarchy of control, you'll nail any question they throw at you on this topic.
All right, that's a huge clarification. Moving on to section 12.3, structure of PMS in India. We've already hammered home the body corporate rule, but let's get into the nitty-gritty of becoming one. Section 12.4, registration requirements.
Right, this is the barrier to entry section. SEBI doesn't just hand these licenses out like pamphlets. You need a certificate of registration, and you have to apply for it using a specific form. Flag this. Form A of Schedule 1.
Form A. I'm looking at the requirements list in the text for what goes into Form A. There's a list of 10 items here. Now, normally I'd say we should summarize, but you know how the exam loves to ask which of the following is not a required disclosure in Form A? So we should probably run through the full list.
I agree. It's a dry list, but let's look at the logic behind each item. What is SEBI trying to figure out?
Particulars of applicant. Name, address, PAN card. The basics. Who are you?
Standard KYC stuff.
Exactly. 2. Organization structure. Who owns you? Is it a publicly listed company? A private entity? SEBI wants to know the entire family tree.
Infrastructural facilities. This is a big one. Do you have a proper office? Do you have computers, Bloomberg terminals, internet connectivity? You can't run a multi-crore portfolio management service from a coffee shop.
They want to see a professional setup.
They do. 4. Business plan. And note the duration they ask for. They want a detailed business plan for the next 3 years.
3 years. That implies they want to see a long-term vision. They don't want a fly-by-night operator who's just trying to ride the next bull market.
That's precisely the reason. They want to see that you've thought about sustainability.
Financial information.
Yeah.
Show us the money. What's your capital structure? What's your net worth? Where will your income come from?
Other information. Have you had any past disputes? Any regulatory actions against you? Are you a member of a stock exchange? Basically, have you been in trouble before?
Okay, so a background check.
A thorough one. 7. Business information. This is about process. How will you profile your client's risk tolerance? What's your grievance redressal mechanism? If a client has a complaint, what's the exact procedure?
Experience. What have you and your team actually done before in financial services?
They want a track record.
Yes. 9. Additional info. This is interesting. They want to see the draft agreement that you plan to have clients sign. And they want the details of your custodian, the entity that will actually hold the client's securities. And finally, 10. A declaration. You have to sign on the dotted line swearing that you are compliant and that you meet the fit and proper criteria.
Fit and proper. I always love that phrase. It sounds so, I don't know, Victorian, like something out of a Dickens novel.
It does. But in finance, it's a very serious legal term of art. It means you have to demonstrate integrity, you have to have a clean record, and you must have financial solvency. It's SEBI's catch-all character test.
So submitting Form A is one thing. Getting approved is a whole other mountain to climb. What are the specific criteria SEBI uses to grant the registration? This is where I see a lot of numbers popping up that feel like exam fodder.
This is absolutely the exam critical zone. SEBI essentially looks at two things: your team and your wallet. Let's look at the team first. The most important person is the principal officer. This is the person whose neck is on the line, the one running the show.
Okay, what are the qualifications for this principal officer?
There are three non-negotiable requirements. One, a professional qualification. This could be a CA, CFA, an MBA in finance, or a degree in law or accountancy. They want someone with formal training.
Makes sense.
Two, experience. And here's a specific number to flag: a minimum of 5 years of experience in related activities. That means working in the securities market as a fund manager, in merchant banking, or stockbroking.
5 years. So you can't be a fresh-faced MBA graduate and become the principal officer?
Absolutely not. You need to have seen a market cycle or two. And the third requirement is, of course, the relevant NISM certification that you're studying for right now.
Right, so you need a brain, you need experience, and you need the certificate. What about the rest of the team?
Well, you must have a dedicated compliance officer. And beyond that, the regulations say you must have at least one other person in your employment.
Just one. That seems low.
It's the bare minimum. But that one person also have qualifications. They need to be a graduate with at least 2 years of experience in the securities market. So your minimum viable team is a principal officer with 5 years experience, a compliance officer, and at least one other staff member with 2 years experience.
Okay, that's the team. Now let's talk about the wallet, the net worth requirement.
This is probably the single most frequently asked number in the entire Chapter 12 exam. To get a license as a portfolio manager, the body corporate must have a net worth of at least 5 crore rupees.
5 crores? That is a significant chunk of change. It used to be lower, didn't it? I seem to remember it being 2 crores.
It did. It was 2 crores for a long time, and even less before that. SEBI deliberately raised it to 5 crores. It was their way of sending a very clear signal to the industry. We only want serious, well-capitalized players in this game. We want you to have significant skin in the game. The logic is, if you can't put up 5 crores of your own capital, you have no business managing hundreds of crores of client money.
It's a steep entry barrier. It filters out the smaller, potentially less stable operators.
That's the entire point. There are other criteria too, like no adverse litigation, no convictions for moral turpitude. But the big ones to remember for the exam are the people and the money.
So to recap the numbers, 5 crore net worth, 5 years experience for the PO, and a 3-year business plan in Form A. There's a nice little symmetry to those numbers.
It certainly helps with the memorization.
Okay, so let's say we've jumped through all the hoops. We have our license, we're operational. Section 12.5 details the responsibilities of a portfolio manager. This is essentially a list of do's and don'ts that govern your daily operations.
It's the rule book you have to live by every single day. Let's break down the most critical ones that always come up. First, we've touched on this: discretionary management. You manage each client's funds individually. But the text adds a very important nuance. You must manage it in such a way that it does not partake in the character of a mutual fund.
Partake in the character of a mutual fund? What does that actually mean in practice? How do you avoid it?
It means no pooling of assets.
Huh?
In a mutual fund, your 10 lakh rupees and my 10 lakh rupees get thrown into one giant pot of, say, 1,000 crores. We both get units representing our share of that single pot.
Okay.
In a PMS, even if we're in the exact same strategy and own the exact same stocks, my Reliance and Infosys shares are sitting in my DMAT account, and your Reliance and Infosys shares are sitting in your DMAT account. They're always legally segregated. There's no single pot.
That's a fundamental structural difference. And that brings us to the ticket size. We know the manager needs 5 crores of net worth. How much does the client need to bring to the table?
Another number to flag in bright red. The minimum investment that a portfolio manager can accept from a client is 50 lakh rupees.
50 lakhs. 50.
50. And again, this was raised recently. It used to be 25 lakhs. SEBI doubled it for the same reason they raised the net worth requirement. They want to ensure that only sophisticated investors who can understand and withstand a higher level of risk are entering this space. The assumption is if you have 50 lakhs of investable surplus, you're not a novice.
Okay. Next responsibility. Acting in a fiduciary capacity.
This is the moral core of the entire regulation. To act as a fiduciary means you are a trustee. You have a legal and ethical obligation to prioritize your client's interest above all others, including your own. This leads directly into the very strict rules on related party transactions.
Yes, I saw this in the text. Investment in associates. This sounds like a potential minefield for conflicts of interest. Can a portfolio manager take my 50 lakhs and invest it in their own sister companies?
They can, but SEBI has put up some very strict guardrails to prevent abuse. First, there's a hard limit. A maximum of 30% of a client's portfolio can be invested in the securities of the manager's own associates or related parties.
30%.
And second, and this is arguably more important, they need one-time written consent from the client, specifically allowing them to do this. It has to be spelled out and agreed to.
30% still feels like a lot. Why does SEBI allow this at all? Why not a zero-tolerance policy?
Well, you have to be practical. Imagine the PMS is run by a large, diversified group like HDFC or the Tata Group. It would be almost unfair to say you can never, ever buy a fantastic stock like TCS or HDFC Bank for your client just because you happen to be part of the same group. But the limit and the consent are there to prevent dumping, which is where a manager takes a bad stock from their own company's books and hides it in unsuspecting client portfolios.
Got it. So the consent and the cap are the safeguards. What about borrowing and lending? Can the manager juice my returns using leverage?
Big red flag here for the exam. The rules are crystal clear. The manager cannot borrow funds on behalf of the client, period. They can't take out a loan against your portfolio to double down on a risky bet.
No leverage.
No leverage initiated by the manager. And they also cannot lend the securities held in your account to a third person unless it's through the proper regulated SLB or securities lending and borrowing mechanism. Basically, they can't treat your portfolio like their own personal piggy bank to be raided or rented out.
That's good to know. And where does the client's actual cash live, the uninvested money?
It has to be kept in a scheduled commercial bank. And the text specifies that funds must be kept in a separate bank account designated for clients. This is the segregation rule again, applied to cash. If the PMS company itself goes bankrupt, your cash shouldn't be seized by their creditors. It's sitting safely in a separate client account.
That's very reassuring. Okay, now let's talk about the part that everyone, both clients and aspiring managers, really wants to know about. The money. Not the investment, but the fees. Section 12.6. Costs, expenses, and fees. How do these guys get paid?
There are generally three structures that the text mentions: a simple fixed fee, a performance-linked fee, or a hybrid of the two. Let's start with fixed cost. It's the most straightforward.
Okay.
It's just a flat percentage of the assets under management, or AUM, say 1% or 2% per year, charged quarterly.
And that's charged whether the portfolio goes up or down.
Whether it goes up, down, or sideways, the meter is always running. This is what covers their basic overheads. Salaries, research, office rent, brokerage, and other transaction costs are separate and are charged at actuals.
Okay, that's simple enough. Then you have the more exciting one, performance-linked costs, the profit sharing.
Right. This is designed to align the manager's incentives with the client's. The pitch is, I only get paid well if you make good money.
Okay.
Typically, this is a share of the profit, say 10% or 15% of the gains.
Sounds fair.
It is, but you can't just charge this on every single rupee of profit. There are two absolutely critical concepts you have to understand here, and they are guaranteed to be on the exam: the high watermark principle and the hurdle rate.
Let's do the high watermark first. The text uses a very visual description, and I think it's worth walking through slowly.
Let's do that. So I want you to visualize a tide line on a seawall. The high watermark is the highest value your portfolio has ever reached. The manager can only charge a performance fee on the new tide that rises above that previous high mark.
Okay, let's use the numbers from the textbook example to make it concrete.
Perfect. Year one, you invest 50 lakh, the market booms. At the end of the year, your portfolio value is now 60 lakh. You've made a 10 lakh profit. The manager charges their performance fee on that 10 lakh gain. And critically, the high watermark is now set at 60 lakh.
Okay, the line in the sand is drawn at 60.
Exactly. Now, year two. The market has a terrible year. It crashes. Your portfolio drops from 60 all the way down to 55 lakh. Now, my question to you is, do you pay a performance fee?
Of course not. I lost money.
Correct. You were well below the watermark. Now, for the tricky part, year three, the market recovers. Your portfolio goes back up from 55 lakh to 60 lakh. You made a 5 lakh profit compared to last year. Do you pay a fee?
Well, I made a profit from last year's low, but I'm only just back to where I was at the end of year one, so no.
That is the correct answer, and that is the power of the high watermark. The answer is no. The text is clear. You only pay performance fees when the value rises higher than the previous highest mark. The manager doesn't get paid for simply recovering losses that happened on their watch.
So they have to make back my money before they can make their own.
Precisely. So finally, year 4. The market continues to do well. Your value goes from 60 lakh to 70 lakh. Now you are 10 lakhs above the high water mark of 60. You will pay performance fees, but only on that new 10 lakh gain. The new watermark is now set at 70.
That is a fantastic system for the investor. It totally prevents the manager from getting paid twice for the same gain if the market is volatile.
It's a cornerstone of fair fee structures. Now let's add another layer of complexity.
Yeah.
The hurdle rate. The hurdle rate is a minimum rate of return. Let's say it's 8%. That the portfolio must generate before the manager gets a single dime of performance fee. It's the client effectively saying, look, I could get 7% in a bank FD with basically zero risk. Don't you dare ask me for a share of profits unless you can beat a basic hurdle of 8%.
So if the return is 7.5% and the hurdle is 8%, the performance fee is zero.
Zero. Even if the high watermark is crossed.
Yeah.
You have to clear both barriers.
That brings us to a term in the text that I found really confusing, catch-up versus no catch-up. It sounds like a game of schoolyard tag.
It's a game of math, and it makes a huge difference to your final take-home return. Let's stick with our example. The hurdle rate is 8%. The manager generates a return of 10%. So there's an excess return of 2% above the hurdle.
Okay, got it.
In a no catch-up structure, the manager only charges their performance fee on that extra 2%. The first 8% of your return is yours, totally free of any performance fees.
That sounds great for me as a client. It's very fair.
It is. But now look at the catch-up structure. The agreement says, once we cross the 8% hurdle, the manager catches up and is allowed to charge their fee on the entire 10% profit.
Whoa. Wait, so crossing the hurdle by even a tiny bit unlocks their fee on the whole amount?
Yeah, that is a massive, massive difference in your net return. In the catch-up scenario, the hurdle acts like a gate. Once you open the gate, the fee applies to everything from the first rupee. In no catch-up, the hurdle acts like a deductible in an insurance policy. You never pay on that first 8%.
That is a pro tip right there. You have to read the fine print in the agreement and look for that catch-up clause.
Always. It can be the difference of lakhs of rupees in fees over time.
Okay, let's move to section 12.7, direct access facility offered by PMS. Now, we have direct plans in mutual funds, which have become really popular. Is this the same concept?
It's a very similar concept, yes. And it's all about cutting out the middleman. In a regular plan, you typically buy the PMS through an intermediary, a distributor, a wealth manager, a broker. That intermediary gets paid a commission.
And where does that commission ultimately come from?
It comes from your pocket, baked into the fees you pay. In a direct plan, you go straight to the PMS provider's door. You say, I want to invest with you directly. No middleman, no commission.
So the benefit is purely mathematical. Lower expenses equals higher net returns.
That's it. It's that simple. Over the long run, even a small difference in fees can compound into a substantial amount of extra wealth for you, the investor.
But the flip side is, if I go direct, I don't have that distributor or advisor holding my hand and helping me choose the right PMS.
That's the trade-off, and that's where the text highlights the important role of a SEBI-registered investment advisor, or IA. An IA charges you a flat fee for advice, completely separate from the product. So they might analyze your needs and tell you, based on your goals, PMS X is the best fit, and you should go and buy their direct plan.
So their advice is unbiased because they aren't getting a commission from the PMS company.
Exactly. The IA's job is to act as your fiduciary, helping you assess if PMS is suitable at all, and if so, guiding you to the most cost-effective way to access it, which is often the direct plan.
That's a great ecosystem check and balance. Finally, section 12.8, SEBI requirements on performance disclosure. SEBI, as we know, loves transparency.
They demand it. And in the PMS space, they mandate a disclosure document. This is a standardized document that has to be given to the client before they sign up, before any money changes hands.
And what's in this document?
It must clearly detail the quantum and nature of all fees, the specific risk factors of the strategy, the accounting standards being used, and the performance of the strategy. And critically, managers have to report their performance uniformly to SEBI, and they have to display this disclosure document prominently on their website.
So you can't just advertise your one great year and hide the 3 bad ones.
The days of cherry-picking data are over. It's all standardized now, which allows for a more apples-to-apples comparison between different PMS providers.
It really seems like SEBI has, over the years, tried to tighten every screw and bolt on this industry to make it safer and more transparent for that 50 lakh plus investor.
Absolutely. The Wild West days of the 90s are long gone. This is a highly regulated, highly accountable profession now.
Okay, we are coming to the end of our deep dive. That was a marathon sprint through Chapter 12. Before we wrap up, let's do a rapid-fire recap of the key exam flags. I'll say the category, you give me the number or the critical rule.
Let's do it. Ready when you are.
Net worth requirement for a new portfolio manager.
5 crore rupees.
Minimum investment amount for a client.
The ticket size.
50 lakh rupees.
Minimum years of experience required for the principal officer.
5 years in related activities in the securities market.
The duration of the business plan you need to submit in Form A.
A 3-year plan.
Maximum investment allowed in associate companies.
A cap of 30% of the client's portfolio, and you absolutely need that one-time written consent from the client.
Who makes the decision in a non-discretionary PMS? The client always decides. The manager only executes on instruction.
And the high watermark principle.
Performance fees are only charged on gains that exceed the highest previous portfolio value.
Incredible. That's a solid list of takeaways. Any final thought for our students who are about to walk into that exam hall?
Just one. We've talked about a lot of rules, a lot of numbers, and some of it can seem very dry. But I want you to remember the big picture. Everything we discussed comes back to one central concept. The portfolio manager acts in a fiduciary capacity.
A position of trust.
The highest trust. That word fiduciary is the heart and soul of this profession. It means you put your client's interests first, always. SEBI's rules are just the walls that have been built around that trust to protect it. So if you ever get stuck on an ethical or a situational question in the exam, just pause and ask yourself, which of these options best protects the client's trust? That is almost always going to be the right answer.
That is a fantastic guiding principle, not just for the exam, but for a career in this field. And for all of you listening, take 5 minutes after this. Close your eyes, seriously. Visualize that high watermark chart. Visualize the tide line on the wall rising to 60, falling to 55, coming back to 60 with no fee, and then finally rising to 70. If you can see it in your mind's eye, you can answer it on the exam.
Absolutely. That visualization locks it in.
Thank you for listening to The Deep Dive. Good luck with the certification. You've got this.
Good luck.